Everyone is wrong about ServiceNow, and I'm going to prove it right now. A stock beats earnings, raises guidance. CEO says AI revenue is accelerating, and the stock crashes 18% in a single day. Does that make any sense to you? Because to most people watching CNBC right now, it doesn't. They're panicking, they're selling, they're calling ServiceNow a broken company, and they are completely wrong. Stay with me, because by the end of this video, you're going to understand exactly what just happened and why the people selling right now may regret it for years. If you're serious about investing and not just following the herd, hit that subscribe button. Let's get into it. Here's what the media is telling you right now. Software stocks are plunging. ServiceNow had its worst single day on record. IBM dropped 8%. Salesforce, Workday, Adobe, all selling off hard. And everybody has a theory. Margin compression, AI fears, Middle East deals. Pick your headline. Here's the reality. None of those people are telling you the full picture. They have airtime to fill. They need a story. And panic gets more clicks than nuance. So let's talk about what actually happened. ServiceNow's Q1 subscription revenues reached $3.67 billion, up 22% year-over-year. Total revenues hit $3.77 billion, also up 22%. And current remaining performance obligations grew 22.5% to $12.64 billion. Read that again, 22% growth in this environment. The company also raised its full-year subscription revenue forecast to between $15.74 and $15.78 billion, up from the previous guide. They beat, they raised, and the stock crashed 18%. You want to know why? Because this isn't about fundamentals, this is about traders. And traders don't care about your 22% growth, they care about momentum, headlines, and right now the momentum is against software. Now let's address the one thing everyone keeps citing, the Middle East deals. Management explained that approximately 75 basis points of growth were lost due to delays in closing several large on-premise deals in the Middle East, linked to the ongoing regional conflict. 75 basis points, that's 0.75%. Think about that for 1 second. The market just wiped out nearly 18% of this company's value because of a 0.75% headwind on subscription growth caused by a war. Not by a broken product, not by customers leaving, not by AI eating their business. These are delayed deals, not lost deals. There is a difference. And if you've ever worked in enterprise software, you know exactly what a delayed deal looks like. The customer is still there, the contract is coming, they just need the region to stabilize first. Fundamentally, this looks like a timing issue rather than a sign of weakening demand. Now here's something the bears are not telling you. ServiceNow repurchased about 20 million shares in Q1 alone. That is more than double the amount purchased in all of 2025. And the board already approved an additional $5 billion in share buybacks. Think about what that means. The people who know this company better than anyone on social media, the board, the executives, they are buying back stock aggressively right now. That is not the behavior of a company that thinks its stock deserves to be this low. Here's something I want you to understand, and this is where most retail investors get it wrong every single time. ServiceNow was already down 30% year-to-date coming into earnings. Then it ripped hard in the weeks before the report as traders piled in hoping for a catalyst. And then, exactly as the laws of technical analysis predict, it sold off after the report. This is called sell the news. It happens all the time. It happened with Nvidia last quarter. Nvidia had one of the best earnings reports imaginable, crushed every single metric, and the stock still went down. This is what traders do. And if you're reacting to traders as a long-term investor, you're playing the wrong game entirely. Now let me put ServiceNow in context, because a lot of people are comparing it to Salesforce and Workday right now and saying those are better. So let's actually look at the numbers. Salesforce is growing revenue at around 8 to 9% right now. ServiceNow is growing at 22%. Salesforce trades at 14 times forward earnings. ServiceNow trades at 25 times. So yes, Salesforce is cheaper, but you are paying for growth, and ServiceNow is growing more than twice as fast. Workday is down over 45% this year. The whole sector is getting hit. This is not a ServiceNow problem, this is a sentiment problem, and sentiment changes. Fundamentals are what stay. Now let me show you what the people who actually do research for a living are saying. Barclays issued an overweight rating after the sell-off, with a price target implying 57% upside from current levels. The analyst said macro issues impacted the results, but were not a thesis changer. And of the 45 analysts covering ServiceNow, 37 rate it a strong buy. 3 recommend a moderate buy, only 4 have a hold, and just 1 has a strong sell. 37 out of 45 analysts, strong buy. But sure, go ahead and sell, because someone on X told you margins are compressing. And let's not forget the actual reason people own this stock long term. ServiceNow's AI product portfolio is on track to exceed the company's $1 billion target for 2026. CEO Bill McDermott said that 50% of net new business now comes from a non-seat-based pricing model, tokens, infrastructure, hardware, and connectors. This is important. One of the biggest fears around AI is that it kills the old seat-based software model. ServiceNow is literally telling you they've already started adapting. Half their new business is already on a new model. That's not a company being disrupted, that's a company doing the disrupting. Now let's talk about what to watch going forward, because I'm not here to just tell you to buy and walk away, there are real things to monitor. Number 1. Watch the next quarter's organic growth numbers. The big question is whether the Middle East deals actually close or disappear permanently. If they close, this whole narrative flips overnight. Number 2. Watch the Armis acquisition integration. ServiceNow just closed a major cybersecurity deal. If they can cross-sell that into their existing customer base, you're looking at a much bigger company in 2 years. Number 3. Watch the Knowledge 2026 conference in May. That is where ServiceNow will showcase its full AI platform. If the announcements are strong, expect a sharp reversal. Look, could the stock go lower? Absolutely. Nobody knows the bottom. There could be more pain in the short term, but here's what I know. The business is not broken. The earnings were good. The deals are delayed, not lost. The AI story is intact. They are buying back billions in their own stock, and 37 out of 45 analysts still call this a strong buy. If you bought this stock, you didn't buy it for 2 weeks, you bought it for 2 years. So relax. Read the actual earnings transcript. Build your own conviction. Don't borrow it from panic merchants on social media. The story is still intact. Disagree with me? Good. Drop it in the comments. Tell me I'm wrong. Feed the algorithm. I genuinely want the debate. But make sure you looked at the actual numbers first, not just the headlines. Subscribe if you want more real talk. No agenda, no sponsors, just the truth. See you in the next one.